Hey guys, welcome to Wealth Wisdom Financial Podcast. We believe when financial conventional wisdom doesn't get you where you want to go, you need wealth wisdom. And I will tell you, a lot of the conventional wisdom, put in your 401k, do all this, and it'll all work out. Don't worry about it, has failed us, right? And we know that. We kind of know it in our heart that something's off, right? And so as we are going through this, and as I do invite guests to be a part of our show, to be a part of our YouTube channel, to provide um, you know information for you guys, but actually help you and people that care about their clients. And I know Amanda was on Taylor's show, and it's the Passive Wealth Strategy show. If you go there and you look up Passive Wealth Strategy and you type in Amanda Neely, you'll hear our coffee shop story and all kinds of stuff. I think she was on there twice, if I remember. So check that out. Go again, look up Passive Wealth Strategy and look up Amanda, and you'll hear her show. But today I get to interview the host of that show, and it's his name is Taylor, and he created a passive wealth strategy show, like I said, and his company is NT Capital to help people like you and me create life on their own terms. You see why I have him on here, because the 401k thing is on somebody else's terms. As an investor who grew frustrated with Wall Street's lack of clarity, again, you can see the similarities, like a clarity, predictability, and nearly non-existent cash flow. He knew there had to be a better way, and so he decided that he was going to help people doing some syndications, do some apartments, and he's been able to acquire, partnered on, and had a hand in over $250 million in multifamily real estate investments. And he likes to help other people get to the next level. And as you can hear from what I shared about him, you can see why he would be a great guest on our show. We don't just invite anybody here, because, well, it's important. So, with that, Taylor, welcome to the show. I'm excited to learn kind of what you've been up to, what you're doing in this crazy, chaotic world we're in right now.
Sure. Yeah, absolutely. Thanks for having me on the show. And what we've been up to in the real estate space is, of course, holding real estate assets that we already own, mostly multifamily, but also some self storage, and looking for good opportunities to take advantage of or capitalize on some of the distress that's out there in the market today. And a lot of that is coming from, as you're well aware of, the high interest rates that we're currently experiencing. And a lot of folks didn't prepare for those high interest rates in the commercial real estate and multifamily space. And that means opportunity these days.
Yeah, a lot of people thought it was going to be up and to the right forever, or down into maybe the left when it comes to interest rates, or something, that they thought it was going to be low, low, low for a long time. I will tell you, whenever I finally bought my first house, we had to wait because we had a coffee shop. We had the money to move and buy a house, but we had no. The business was fairly new, so getting a mortgage was really hard when you have little income or you don't have a history of a business. Even though I had the money, I was like, "Dude, I have plenty of money." And so we finally moved, had to wait a year, finally moved March 13th of 2020. And I was worried that it was going to be the worst time to buy a house. And apparently, as you know, it was probably one of the best.
Yeah, that was incredible timing on your part. And, you still would have been able to potentially take advantage of some of the super low interest rates if you wanted to refi when we had those
Mhm.
super low interest rates. But I think in investing generally, when we get stuck worrying about short term anything, whether it's rates
Mhm.
being high now or rates being zero there for a little while, at least the Fed funds
Yeah.
rate, it's instructive to zoom out, take a bigger picture, look at the long term trend. And in real estate in particular, folks tend to kind of get stuck in this idea that, oh, it always goes up. But in the short term, things kind of go up and down, right? It's a little bit
Yeah.
of a roller coaster. Long term, of course, yeah, real estate does have a good track record of long term appreciation, but people get in trouble when they don't plan for short term ups and downs. They don't plan for short term ups and downs in interest rates. And that leads to oftentimes poor decisions when it comes to reserves, debt planning, things along those lines. But long term, as long as we're on the fiat currency, I feel good about owning hard assets. You just need to be prepared for the down times when they come because they always do.
Yeah.
That's
Yeah.
just life. It's up and down, right? So just be ready because they're going to come, but just
Yeah,
part of life.
I think that's being a business owner. You've probably seen, the long range. We think, oh, yeah, it's going to be easy. It's even starting our own business. We're like, oh yeah, it's. Why wouldn't it be easy? And then you get into it, and you're like, well, there's this that happened, this thing, all kinds of random weird stuff that is in the short range, annoying. And then long range, what can happen, right? And so same with the market, right? Short range, we think, oh yeah, it's going to be low interest rates forever, and then things change. I mean, I don't know what's going to happen. I don't know, in the next year or something. We could have aliens. That's going to drop the market, right? If we have aliens, zombies, shoot, um, and how to best be in a position regardless of what happens, right? But knowing, and you said something that you invest in that I thought was really interesting, storage, like facilities.
Mhm.
Um, why do you think that's such a great investment right now?
So I actually think it's a very difficult investment right now. I think in general, as the self storage business goes, I love the self storage business because, hey, Americans, we love our stuff and we
Yeah.
can't always put it in our home, or
Yes.
sometimes we move and we need to store our things in a space until we can get them where we want to go, or a lot of other use cases for self storage. Businesses use a lot of particularly climate controlled self storage, but not only climate controlled.
Yeah. Yeah.
Plus, you have through COVID with multifamily in a lot of areas, we had this eviction moratorium that was difficult for a lot of investors, but that did not apply and frankly never will apply to self storage. Nobody's, got any kind of, bleeding heart for self storage folks,
Yeah.
right? It's a lien law thing, not an eviction law. So there's an upside or a potential, a benefit there with self storage that, it's not hard to get non payers out of a self storage unit.
Yeah.
But the thing that makes self-storage particularly difficult today, not that it's not a good business, the business case is still very much there in the vast majority of markets, still goes back to those interest rates. And it gets to the deeper part of really how self-storage investment business models work.
Yeah.
Typically, when you buy a self-storage facility, you'll buy it that it already exists. There's some in-place cash flows, and then the goal is generally to add value to the property in some way. And in commercial real estate, the way we add value is by growing the net operating income. And in self-storage, there are two primary ways to do that. Raise rents on your existing units, and there's very good potential there in most places. And then the big upside that a lot of folks go for is expanding the property, adding additional square
Yeah.
footage, additional
Yeah.
units, and that's great. And it works really well. And as long as you know what you're doing and understand how long it takes to do that construction and lease things up, hint, it takes a lot longer than most folks think, but that's okay. It's great. But the hard part right now is with the high interest rates and the high cost of construction, it makes
Yeah.
it hard to make a self storage deal what we call pencil. It makes it hard to make the math work, essentially. You don't want to make the math work. You want the math to reflect reality, but that's what we say.
Yeah.
Makes it hard to make it pencil. The other part of that is that folks who are holding self storage properties now, myself included, not really that motivated to sell given the current high interest rate environment. So
Yeah.
sellers
Yep.
generally still have high price expectations that are, and a lot of times, based on the environment we had when interest rates were a lot lower. And if you don't need to sell these days, you're kind of probably not actually selling. but still the listings and the opportunities that I
Yep.
see in self-storage, there's just a mismatch between what a buyer or an investor can pay today versus a seller's expectation. There's this concept of negative leverage, right? When your cap rate is below your actual interest rate that you're paying on the debt.
Yeah.
That would be the case in a lot of these deals. So, business case still 100% there in the overwhelming majority of markets that I've seen and the most opportunities I've seen. The tough part is really the pricing and the overall cost of construction once you factor in materials inflation, labor
Yeah.
inflation, and of
All the
course,
things.
cost of debt.
But and my one thing I'm kind of interested in the future, right? So thinking long range is something I again going back to is as generations change. There's that tiny house movement, right? Maybe they have things in storage units, or maybe they don't have things, right? And I wonder if our um, I don't know, maybe we're going to have more storage units and less. Um, you know what I'm saying? Like it's one of those interesting as the baby boomers transition, if you will. What is our environment going to look like? And do we have bigger houses or smaller houses? What is younger people's financial freedom number look like? Because a lot of people aren't valuing stuff anymore; they're valuing experiences.
Mhm.
Uh, and it looks like um, you're not 65, right? I don't think
34. Right. That's right.
34, right? So and if you're listening to the show, not the video, right? Younger, right? So there's different things, and maybe we've learned. I bought all this stuff, like our parents bought all this stuff, and they're saying, "Man, I'm not happy. I want cash flow so I can do the things I want to do." And so you've been able to say, "Yeah, well, older people have a need to keep their stuff because they've acquired it all, but they had to downsize because of situations." Um, right? Are you seeing some of those shifts, or do you kind of think about that stuff very much?
Yeah, we often talk about self storage as a business of transition, life
Yep.
transition in some way. So you're exactly right, folks downsizing, but also folks upsizing, right? When the economy's going well and people are upsizing their homes, they still have to put their stuff somewhere generally for some period of time. And
Yep.
also, there you can contract with U-Haul and do the rental trucks and everything. But also, there's relocation, right? People need to put
Yep.
their stuff somewhere generally for some period of time. So there's the business of transition is what a lot of folks call it. And I think on the baby boomers kind of phasing out, it's interest. I think it's going to be interesting to see how that goes because most folks aren't in the financial position that they need to be in at really any
Yeah.
age or any decade of their life. Like I'm in my 30s, and I kind of like I said, and I look at the averages or the medians for folks that are in their 20s, 30s, 40s, 50s, 60s, things like that. And really everybody on average is below where they need to be. And that's particularly concerning for baby boomers who are getting to that period in their lives when they're going to be retiring, whether voluntarily or
Yeah.
involuntarily. It's a big concern. How many of them are going to be really able to afford long-term care, right? Whether they need
Yeah. Right.
to have full time somewhere or have somebody come by, and it's concerning. I don't know what the fix is going to be, right? Markets find solutions and water finds its level, but a lot of folks talk about when boomers do start moving into longer term care or downsizing. What's going to happen to their homes? Is that going to open up opportunities for millennials, my generation, to either get our first homes or to upgrade from the first to the
Yeah.
second, and things like that, and Gen Z coming along. But I always try to keep a positive view of things. I was just doing an interview on my show last night with a realtor and real estate investor who's based in Canada, and they have a very interesting situation and concerning in some ways because their housing affordability is significantly worse than ours. They have much
Yeah.
more population growth and much less new construction. So they're going to have even more scarcity in their housing moving forward. And their properties are they can't get 30-year mortgages, right? In the US, we get 30-year mortgages and we kind of take it for granted a little bit. Can't everybody get a fixed 30-year mortgage, right?
Yeah.
In Canada, they don't have that. They have 5 years and then the mortgage rate resets after that 5 years and you're kind of left maybe holding the bag if you bought your house at 2% and now it's 6 or 7, well, you're going to have to come up with that extra payment every month. So I believe there will be opportunity there. I think there will be obviously opportunity here in the US, but only those who are skating to where the puck is going and are thinking about what opportunity is going to be created. Those are the people who will be able to capitalize on it.
Well, and a couple things that I think and I see from you and the average person. So my mentor has a podcast called Not Your Average Financial Podcast. So I don't want to be average. Like average sucks right now. Like it looks really bad, right? I'm like, average individual is depressed, broke, and all that. I'm like, that's not. And we have the opportunity in our show. And if you're listening to the show, I know you're not average. And you're saying, okay, well, there's a way to help people and also make some money and think through it in a different lens. And if I look behind you, you have a lot of books that you've read, it looks like, and you are above average in that regard because most people just put their head in the sand and say, I got this, I got my house, I got my credit cards, it's okay, let's just not worry about it. So I have a feeling, when you're 60, it's going to be a different story for you than it's going to be for a 30-year-old who's like at the bar right now, right, or something, right? You know what I'm
Yeah,
saying?
yeah, yeah.
Um, and they're spending it all on I don't know, crazy stuff. Um, and so the thing I think about, there is still understanding how the banks work and how what's happening with the Fed, the markets. And so you also do syndications. Why did you jump into that? So like of all things, why not have I don't know, um, fix and flips or other things? What was that pull for
Sure.
you as opposed to any other kind of real estate?
Yeah, so when you get into real estate, generally you learn how many ways there are to make money in real estate. There are so many
Mm.
options. I just did an episode the other day where my number one lesson from having now interviewed over 700 real estate investors is that the folks who perform the best in the short and long term are the ones who focus on one thing and they say no to things that don't fit them. And they avoid that shiny object syndrome is what we call it in real estate. But for me, the reason that I started getting interested in syndications is, there's a story. So back in 2011, I was driving to my job at the time, probably around 7:30 a.m. or so. It was a nice, cool fall morning in Lancaster, Pennsylvania. And I lived in a townhome complex at the time. It was a rental, and I was driving past through the complex, and I drove past the office, and it was a decent townhome complex, probably B plus, A minus class, not
Mhm.
the nicest place in town, but decent. And parked outside of the office, and this is before 8 a.m., was a brand new Audi A8. It was new at the time. And I'm a little bit of a car guy. I like cars. And I thought, man, I wonder who owns that. And then it hit me. I bet whoever owns that owns this complex. And then bam, it hit me again. Wait, people own apartment complexes. How in the world do they do that? And at the
Yeah.
time, I didn't have the answer to that question. I didn't know how they did it. I just kind of assumed that they were probably already rich from some other way. I
Yeah.
don't know how they made money elsewhere and they just bought apartments. And that might be true, and that is true in some cases, but then a few years went by, and I learned that the way people buy large apartment complexes and commercial real estate is that they pool their money together in what's called syndication and buy those assets, and then a small group of the people in that pool manage the asset, manage the business plan, and they all split the returns essentially is how it works. And
Yeah.
that I always think back about that experience of it initially hitting me that people can own these things. And I saw this guy had a sweet car, and I was like, I bet so he owns this. And I saw the kind of the fruits of that. And then time went by, and got more and more excited about the potential to own something that large, even if I'm splitting it amongst a group of others. That's fine by me, right? Because we're splitting a common pie and we're all making money together. That's sat very well with me as compared to doing a single family and things like that. And that's fine. You can certainly make money that way. I'm not
Yeah.
coming down on that, but apartments just got me so excited that that's what I wanted to do.
Yeah. I see that as, and I just thought about this, as syndications are kind of like the co-op model, right? You're going in together collectively, and you have some mutual benefit, right? So as I think about even what I do with the infinite banking, is very similar. It's a policy, and we it's a co-op. As the business model grows, we get a return of premium, which is healthy and helpful, and then it just goes back through, and it's almost a sense mitigating the risk, because if there's a bunch of people together, then if a flood happens or something, we're able to overcome that, as opposed to, because I also have another client that didn't do a syndication, but they got an apartment complex, and they had, I don't know, a lot of refrigerator breaks and things like that. A lot of those things happen. So then they end up going into a bad debt, because they didn't have the backing of the community, right? Because they were the individual, which is great sometimes, but being able to have the balance of that, and maybe that's true. I'm not an expert in syndications. I just kind of thought about it. I was like, oh, that sounds similar to that kind of model. Would you think so?
I think it's an interesting take. I would say in the syndication space. So remember, you have two groups of people in a syndication: the limited partners, who are the passive investors, and the
Hmm.
general partners, who are the people who find the deal, operate it, do all of the legwork essentially. And then everybody splits the profits at the end, of course, assuming there are profits, depending on
Yeah.
or along the lines of their agreement. The important thing, or one of the many important things in a syndication, is that the general partners have the level of experience to know how much they're going to need in reserves, that they
Yeah.
know how to do proper financial and physical due diligence to make sure they're not going to have a bunch of unexpected repairs and maintenance and things like that.
Yeah.
Nothing too surprising, or that they know how to properly insure the building so that if it is in a high likelihood of flooding area, that everybody can be protected with the proper insurance policy. Syndication does have a way to kind of go back to the group essentially and ask or kind of demand more money. It's called a capital call. For
Yeah.
a syndicator, you never want to have a capital call on your record. You should do everything in your power to totally avoid that situation. But that comes back to understanding what you're getting into, having enough reserves, having folks who are qualified in the actual day to day management, or what we call asset management of an apartment
Yeah.
complex, so that things don't get so bad that you need to go back to the well. And unfortunately, since there's been such a big groundswell of folks investing in this space, which is great, the downside is that a lot of the, I'm going to say, gurus in the space that are telling people how great it is are forgetting or not including some of the most
Yeah.
important things, which are the due diligence side of things, and of course asset management, meaning that, okay, we've bought this apartment complex, which is the focus of so many of these training programs, and they just kind of say, yep, all right, you're done. But you're not done. That's day one. Day one is when you close, and now your job is to make sure the business plan gets executed. So that goes back to having experienced people on the team who know what it takes to manage a property manager, and not just put them
Yeah.
in place and say, all right, go figure it out. No, property managers need to be managed. We were talking about managing people before we started recording here, right? And that's so important, and I
Yeah.
think has been left out of way too many of the conversations in this space, is the actually running a business side of investing in apartments.
Yeah, so that leads me to something else. Again, just thinking through this, is there's a lot of gurus out there. There's the Dave Ramseys on my world that say stupid stuff that I'm like, that is not even true.
Not
Uh,
like infinite banking. I know that much.
right. Oh, I know, and it's not true, right? And then there's some people who are in the real estate guru world who are selling things and saying, "Okay, you just buy my program. It's going to be amazing. Here's give me 100 grand, and I'll do this for you." Um, and how do you, as a new investor, these guys are people who are thinking about syndications. How do you figure out who to work with? What's a good deal? Not be all Twitter pated that, oh, I want big rates of return and all of that stuff, because that's what Dave Ramsey will say, well, blah blah blah, and sometimes it's not real. Like, how do you talk to a client and bring them to reality and also build a good foundation? Because I mean, again, why I love the policies is that it's able to do something. And if I have a flood, which literally I've had a couple floods, unfortunately, I was able to access my policy as my contingency, which I don't want to do, instead of just sitting in a savings account, right? So how do you help people in that world to make sure they're making smart decisions? Do you say, you don't need to do a syndication, or what do you do? You tell, like, how do you figure that out?
Sure. So I never give anybody advice, provide education, and everybody makes their own decisions. And that's for important regulatory compliance
Hmm.
reasons, of course. But, for somebody who's kind of thinking about getting into the syndication world, I'd say the very first step is to get educated. And a lot
Hmm.
of times in real estate, when people say get educated, what they really mean is go buy my program. I don't
Yeah,
sell a program. I don't have that. When I say get educated, I mean go pick up books on how these asset classes work. There are a lot of books on Amazon that are 20, 25 bucks a piece about apartment investing or self-storage investing that you can get and read and invest some of your time in. Because if you're thinking about investing 50, 100, a couple hundred thousand, $1 million in an asset class, then why not start with $100 or $200 worth of books and a
right.
few hours of your time to
Yep.
understand how these deals work? So build that foundation. You can learn an awful lot just by reading, but you don't need to stop there. You can
Yeah.
go out and network with people who are doing what you want to do. There are groups out there for passive investors who are just groups of passive investors with nothing to pitch that will, walk you through their successes and failures and things like that. So consider joining one of their groups. And then I also believe that investors in anything, no matter what it is, should try to avoid FOMO, or the fear of missing out, right?
Yeah.
If we're so excited to get into something that we're going to jump into the first thing that we see, I think the odds of making an intelligent decision in that case are not as high as they could be. Not impossible, right? I've made snap decisions that turned out to be good in the past, but I think it's less likely than if we look before we leap. So maybe before you jump into the very first thing you see, take a look at a couple other options first.
Yeah.
And I recently had a friend of mine and a former business partner who we'd done a deal with on my podcast. And she said her kind of top three things in any deal that folks tend to consider are, in a particular order, the returns, the market, and then the operator. Those three things. And a lot of investors will look at those three things in that order. But in her opinion, and I totally agree with this, her
Yeah.
name's Ashley Wilson. I'm just trying to give her due
Yeah.
credit with this. Um, Folks should go in the opposite direction. Look at the operator first, then look at the market, then look at the returns. But a lot of folks in the passive investing space will just try to scroll straight to the page on the presentation or whatever that details the return projections. And then if that's in line with what they want, then they'll go to the next things. But that's a bit backwards, because when it comes to projecting a return or what have you in a syndication or any investment, well, it's just numbers on a page, right? Those
Yep.
numbers need to have some kind of grounding in reality if they're going to be any kind of realistic return projection. And the only way you can really know if they have a grounding in reality is if you've gotten that education and you
Yeah.
understand how these deals work. So once again, a really comes down to that education. And I'm not saying go buy an expensive program. I'm saying read books that you can get. Heck, I've got, books behind me right here that I've learned an awful lot from. And you can get a really solid foundation for how
Yeah.
this business works.
I think that's again what you just said. It's not returns, market, and operator, which people are looking at. Hey, what's my biggest return? Partially, I think it's because they're screwed, and so they're like, I need to make up for it. I need a big return because my 401k has said otherwise, or whatever, and so they're chasing this, and they're not looking at the business model, right? um, and seeing it as a business model, which is really, really important to think about, and why I think I'm doing better. And personally, is because I'm run a business, right? And that helps to think things in a different light, right? Um, Something I was also thinking about is we have our book Five Smooth Stones, and the reason we wrote this book is it's a interactive money journal, and it's $40. You know how many people say $40 is way too much? I'm like, it's an interactive money journal. It's for you to think, and they're like, yeah, but I just want a book, because you could have all of those books that you have behind you, but if you don't think about them, you don't spend some time journaling about them. A lot of people have those, but it's the action, systematic action with those books, and I think that that's something that we're missing. But then again, I hear people, it's $40, I can't afford it. I'm like, well, then you shouldn't be affording putting it into this deal or that deal, thinking it's going to be great, because that's even worse. Right? Does that make sense? Um, and
Yeah.
again, I see it all the time, which is why we wrote the book. So I want to show this. You said the other way, instead of returns, market, and operator last, you said operator, market, and then returns. You want to find the good business model or person, look at the market, and then returns. Maybe, again, maybe you go backwards and forwards, and almost like what they say is stress test it. Right? Um,
Yeah, and I think you could add a few more things in there, of course. The property itself is, of course, a
mhm.
critical part of any real estate deal.
Yep.
Personally, earlier on in my multifamily career, I was more willing to invest in older C-class properties, and that went okay for a time, but I think COVID completely, for
Yeah.
me personally, destroyed the C-class market, C-class apartment investment market. They just got too expensive to do. Plus, they're such a big headache. So I only invest in B plus and A minus class multifamily.
Yeah.
Now I won't invest in anything built in the 1970s and earlier, and even 80s is a little bit shaky. But if it's in good shape, I'm willing to do it. But once it's 70s and older, honestly, there's too many problems, too many skeletons in the closet that you're going to have to fix. So there are, of course, other things to consider beyond that. But the point is that kind of looking at things in the right order, probably starting with the operator, in my opinion, market, you can add in the property and other things, but putting that the return projections, giving them lower priority. And I think it's a matter of protecting yourself too, because think back about, I hate to say this, but Bernie Madoff, right? He was running a scam the entire time. A lot of people knew it. The regulators didn't realize it, but people kept investing with him because he was showing these incredible returns, even though none of them were real. And he just sustained it through the Ponzi. But understand what the actual business is first in order to protect yourself. And a lot of people knew what he was doing and pointed that out to the regulators. They said, there's no way in the world he's making this money, and they were right. But,
Yeah.
you know, digging in is really how I think you protect yourself.
I mean, I think that whoever that Sam Bankman, uh, is that his name? Sam Bankman
Right.
Fried? I'm like,
Sam
God,
Bankman Fried.
yeah, isn't that very similar to the other one that Bernie kind of idea? I was like, it sounds similar, and I bet you there will be a Netflix series in the next few years. I should, on that one, and I bet you if you watched it similar to the Bernie Madoff series on Netflix, it might be, I just think it'll be interesting. And again, there's always people who are looking for the quick fix, right? It's going to be easy. I just need to do this or that. And there has to be people like us saying, hey, there are great ways to make money. There are good ways, but do your due diligence, do your thinking, understand how this works. We do want, as your um, podcast is called Passive Wealth Strategy, right? We do want passive income. It takes effort to build passive income. It takes thinking, and I do think that there's a lot of people who want you to think for them, or not me, or what I'm saying. Like, there's a lot of people who just, I don't want to think. I'm like, well, no, you need to think for yourself, but also to build passive income requires a lot of thinking time. Like, was that guy? Thinking, not thinking, grow rich. The man, I can't. Road Less Stupid is a book.
I haven't read
Um,
that yet. That's been recommended to me a few times. I have not read that book
yeah,
yet, though.
so it's thinking time. What I think is important is we need to have that, and as you do that, as you level up, man, I'm working in mine of like, okay, I have this big foundation. I have a great foundation that we've set. Now, because I have a good solid foundation, I'm able to be smarter, not smarter, but do more with our money to build more passive income, right? And also, what I love about what you're doing, what we're doing, is you're around people who are smarter than you in a lot of areas, and you're like, hey, you're really smart. How about I take a little bit of your smarts and now work with you? And I think that that's missing in our world. We'll go with the gurus, but also knowing, hey, I went into a mastermind. It's called Gathering the Kings. I'm like, I want to join this mastermind to be around people who are smarter than me, and investing in those kind of things too. So, um, real quick, I want to show your website. I want you to share a little bit about here and make sure I didn't miss anything. So, um, I know we could go on. We could talk about this stuff for hours. You're very similar to us. So, passivewealthstrategy.com. Tell us a little bit about the site.
Yeah, so it's really centered around my podcast, the Passive Wealth Strategy Show, and the tagline is we our goal is to help our listeners learn how to build wealth with real estate without buying themselves another job. And there are a
Hmm.
lot of ways to do that. It's not just real estate syndication, of course. There's, folks build their own real estate portfolios, but the fear I think in real estate that keeps people out or keeps people from getting started are all of the horror stories that we've all heard from our, uncle's nephew's cousin who had one rental property with one bad tenant. It took him all his time. He was always fixing the toilet. It was just a big nightmare, right? But the truth is that even if you want to go that route, you can learn ways to build that into a more passive, not 100% passive necessarily, but turn it into something
Yeah.
that's not a job. Hiring managers, doing the right due diligence on your properties in the first place, buying at the right basis, all things along those lines. That's really the goal that of the show, is to give people those tools if that's the route that they want to go. But really getting behind the curtain of real estate investing, really, and teaching people how deals go. And of course, it's like you mentioned, getting around people who are smarter than you or richer than you or whatever. I mean, shoot, my podcast has been the number one way that I've done that in my
Yeah.
life, even going beyond, all the networking events and everything that I've been to. It's just been a fantastic way. I just see you scrolling there. You scrolled past,
Yeah.
say, Richard Wilson from the Family Office Club. Well, he's a guy I may never have had the opportunity to meet, but got to have him on my podcast and share his message with folks out there. And, he's someone who his whole business is based around helping family offices. So that's families with
Yeah.
net worths 50 million or more, sometimes up into the billions, and helping them all meet each other and find investments and everything. And it's just been, a great journey. Like I said, I've recently passed around 700 interviews recorded, and been yeah, it's been a ton of fun. It's been a little bit painful in a certain sense because I'm not necessarily someone who likes to hear myself talk or see myself on camera, but you have to get comfortable with that. You have to get comfortable being uncomfortable. And to kind of go back to something you'd alluded to along the lines of being around people smarter than you is
Mm,
becoming unafraid to ask dumb questions. And dumb questions, people like to say there are no dumb questions, which I think is true, but I'm putting the qualifier dumb on there, dumb by your own judgment, right? I have
yeah,
questions that I think are dumb, but getting unafraid to ask those things because you would rather have the knowledge and get less dumb. And that's
right.
been great for the podcast, but also great for my own business growth. And sometimes if I have a question that's too dumb to ask publicly, then I'll ask it privately, right? But getting it for unafraid to ask dumb questions of people who have achieved things that you want to achieve. So yeah,
One of the things I noticed too is you said, how many people have you interviewed?
been over 700 now.
700. So everybody wants to start a podcast nowadays, and I feel like there are tons of people who said, "Oh, I'm just going to do it. It's going to be easy." Podcasting isn't that easy, right? Um, there's a lot to it, but you were able to talk to 700 people, and what I noticed, even in your thing, is you said 700 people. That is consistency, showing up, right? Even today is Saturday, yeah, afternoon. I'm sure you'd rather be doing something else, right? But like as we record this, but like thinking about like some of the sacrifices that you've done, and again, some of our world is saying, "Oh yeah, but I want the results without the work." Right. And it might not be financial or uh, capital in the form of cash, but you've done a lot of sweat equity here, is what I can see. Um, right.
It's been a lot of work, and I do have a team now to handle a lot of things on the show because your most valuable asset in life is your time. You can go get more
Mhm.
money, you can never ever in the world go
Yep.
get more time. Somebody invents that, that'll be a game changer. But that's been huge. And I think something that I heard recently that I've been thinking about a bit is have you ever watched It's Always Sunny in Philadelphia?
I
Maybe.
have not, but you could tell me about it. I don't even.
Incredible, hilarious sitcom, very very vulgar. It's been on for some time now, but the creators of that show, they kind of created it in their spare time. They got on FX. Eventually Danny DeVito got on the show. It's just incredible. But
Yeah.
they have their own podcast. It's currently on hiatus, but there was one episode where they're taking like listener questions or something like that. And the topic came up of working and their message, they're in the office. It was probably a Thursday morning their time. And these are successful actors who are now incredibly wealthy. Rob McElhenney, one of the creators, just bought a soccer team with Ryan Reynolds. That's how much
Right.
money this guy has. Their message was everybody works. And I thought that was really interesting. These guys are at the kind of the top of the entertainment game. If you're interested in that kind of entertainment, everybody kind of knows who they are.
Oh yeah.
He just bought a soccer team with Ryan Reynolds, just very successful. These guys have been in a lot of movies, but their message was everybody works. You get to this point by being willing to work. And I think that goes across the board, no matter what
Yeah.
industry you're in, is, you got to be willing to work, whether it's in the real estate side or in some way that you can add value to someone to, earn funds and invest them. And I think something that'll really resonate with you that I think in general, folks don't in this financial space think about often enough. And something that I'm very grateful for to my past self that I did is understand the time value of money and the time value of investing to kind of go back
Yeah.
to the discussion of trying to earn maximum returns. Well, to build a lot of wealth or passive income or however you want to qualify it, you really only kind of need to hit base hits
Yep.
consistently for a long period of time, even a moderate amount of time, but those base hits really add up. So for
Yeah.
me, something that I'm very glad that I did when I first started earning money is that I was very fastidious about budgeting. I got a budgeting app. It was like the first budgeting app that's available. Is not out there anymore. Mint, they just shut it down. But I had that from day one. I was really watching my money, and then any money I had left over, I was investing in, and then that went
Yeah.
on to compound, and that was my early 20s. Now I'm in my 30s, and doing that in my 20s laid a foundation in order to have, wealth that I can now place in different places, and just it's more to grow. And if
Yeah.
we take that longer term view of wealth accumulation, then I think it's less stressful, one, and it's also just I'm hesitant to say less risky, but I think we're less likely to take risky moves if we understand just base hits is all we need.
Yeah.
Consistently, excuse me, for a long time.
I think again we're speaking the same language here. People want the home runs, but it's the base hits. And then again, while we wrote this book, the Five Smooth Stones, it's the profit first idea, right? Pay yourself first, building the big rocks in place, right? And so that's why I love the life insurance piece, is because it's building that good foundation. But honestly, I didn't think I was going to be a budget counselor half the time. Um, and it's just like deploying your money in the right positions. And as you do that, things just get more fun. And then really, I think about you can really only do two things with your money. Um, and a lot of times either you can cut expenses, right? Somewhat, but then inflation eats into that, right? And you can make more money. Um, right. But then you also don't want to make more money at the expense of time. And a lot of business or people are saying, I want financial freedom so I can quit my job and just get passive income or something like that. And I'm like, all right, what is it? Yeah, my soul sucking job or whatever. And so it's about building the good foundation so you can transition. Now and as I talk to clients, they're like, I'm not planning to just like not do anything. I just orient my life towards something that brings me joy in life and still making a difference, right? And so I think that that's what's shifting a lot, and it's interesting, this passive income or retirement. It's just thinking those words, reorienting those words in a better way. But it all starts with budgeting your time and your money when it's smaller, and then it's all percentages. Like seriously, I'm like, well, I just do percentages, and I just happen to make more money, and it's a bigger percent. I mean, it's same percent, it's a bigger dollar amount, right? Um,
Absolutely.
yeah, and I think that that's so easy. It seems logical and like all of that, but we're taught consume, 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 chaos, confusion, haphazardness, all that, not the other side. So, anyway, anything else you'd like to leave our audience? I did want to share. Here's Amanda. If you go here on the site, and where did it go? I lost her. Maybe I just lost her. I did have Amanda here. I pulled up two of the same. So if you go Passive Wealth Strategy Show, you'll find Amanda's episode. I don't know when she recorded it because well, even though we're in the next to each other, I don't know what the heck she's doing half the time. So she shares our crazy story of the coffee shop um, there, and I love this. I love that you actually have the transcript on your show too. We're going to do that more on our end. So, um, anything you'd like to leave the audience before we wrap up here?
I'd say going back to the idea of having a long time horizon and aiming to hit base hits rather than home runs is really what I see as the path to wealth.
Cool. Well, that is great. I love that. I do have a client that's a former baseball player, so he'll love it too. If he's listening, I'm not going to say his name because that would
Naturally.
define confidentiality, but it's kind of fun. So everybody go to his show, subscribe to his show, and get on a call with them. Ask questions, right? No question is stupid, right? You want to get on there, and I'm sure he's going to help you when it comes to syndications, real estate, and all that. So with that, you guys have a great day. Think for yourself, build the life you want. Don't just depend on me or us here. Really think through what it means for you, right? Taylor isn't going to have all the answers either. So,
Unfortunately not.
yeah. Awesome. Thanks, guys, and we'll see you next time.